Did you know your RRSP, the cornerstone of your Canadian retirement plan, might actually be costing you thousands in hidden taxes and lost government benefits? For decades, Canadians have been told the RRSP is the ultimate retirement savings vehicle, a tax deferral paradise. But today, I'm pulling back the curtain on the uncomfortable truth no one tells you. We're not just scratching the surface here. We're diving deep into the hidden tax traps, the biggest myths, and the phantom taxes that could shrink your retirement income significantly. You'll learn precisely how to safeguard your hard-earned savings and ensure your retirement dreams don't transform into a financial nightmare. I've spent years analyzing the intricacies of Canadian financial strategies, helping countless individuals navigate their retirement plans, and what I've uncovered might shock you. Imagine diligently contributing for decades, only to discover unexpected pitfalls. In a recent analysis, it's estimated that over a quarter of Canadian retirees with substantial RRSP assets face unforeseen clawbacks on essential government benefits like old age security and the guaranteed income supplement. This turns what you thought was a smart tax deferral into a silent wealth erosion. Are you absolutely certain your retirement plan is working for you or against you? Many Canadians faithfully contribute to their RRSPs, genuinely believing they're doing everything right for their future. But what if that perfect plan has critical, unseen flaws? What if the very mechanism designed to save you tax up front is subtly setting you up for a nasty surprise down the road, potentially costing you far more in retirement than you ever saved? You might feel a sense of unwavering financial security right now, but beneath that calm surface, hidden complexities like insidious tax traps and unexpected benefit clawbacks are lurking, threatening to erode your financial peace of mind just when you need it most. This isn't just about taxes, it's about your entire retirement lifestyle. Today, we're going to expose these untold truths about RRSPs head-on. We'll uncover the hidden tax traps that creep up on you, debunk the biggest RRSP myths that persist in Canada, reveal exactly how your RRSP could be costing you vital government benefits, and show you why the phantom tax is a very real, tangible threat to your nest egg.
Crucially, we'll equip you with advanced, actionable strategies to not only avoid these pitfalls, but to truly maximize your wealth. Understand the real, often overlooked winner between the RRSP and the TFSA, and master your withdrawals to pay significantly less tax. This is about taking back control. The hidden tax traps you don't know about, and yes, the phantom tax is real. Most Canadians are taught that RRSPs are simply about deferring taxes. You save tax now, pay later. Sounds simple, right? But the reality is far more nuanced. The phantom tax occurs when you withdraw funds in retirement at a higher marginal tax rate than the rate at which you initially received the tax deduction. Or, even worse, when those significant withdrawals push you into an unexpectedly higher tax bracket during retirement, silently eroding your effective income. This scenario plays out repeatedly because people often underestimate their true retirement income needs or, more critically, fail to project future tax rates accurately. Think about this. You contribute to your RRSP in your peak earning years, say at a 30% marginal tax rate. That feels great. But what if, in retirement, your RRIF withdrawals, combined with your CPP, OAS, and any private pensions, push you into a 40 or even 45% marginal bracket? That 10 to 15% difference isn't a deferral, it's a silent surcharge, a phantom tax that significantly reduces the real value of your lifetime savings. You gained 30% up front, but you're losing 40 to 45% on the back end. The immediate action you need to take is to start projecting your likely retirement income and potential tax brackets with realistic assumptions. Never, ever assume your retirement tax rate will automatically be lower than your working life rate. By truly understanding this phantom tax, you gain the power to strategically plan your withdrawals and coordinate with other income sources to minimize your overall lifetime tax burden. But this isn't the only unseen cost. Your RRSP could also be jeopardizing the very government benefits you're counting on in retirement. RRSP's secret cost: losing your OAS and GIS benefits. This is a critical point many Canadians overlook. Once your RRSP is converted to a Registered Retirement Income Fund, or RRI, and you start making withdrawals, that income is fully taxable and counts directly towards your total net income. And here's where the danger lies. This taxable income can trigger painful clawbacks on essential government benefits like Old Age Security, or OAS, and the Guaranteed Income Supplement.
These benefits are income tested, meaning the more taxable income you declare, the less you might receive. For OAS, if your net income exceeds a certain threshold, which adjusts annually, currently around $86,000 for 2023, a portion of your OAS is systematically clawed back. For the Guaranteed Income Supplement, the impact is even more severe and kicks in at much lower income levels, directly affecting low-income seniors who rely on it for basic needs. Imagine a scenario where a sudden, larger-than-expected RRIF withdrawal pushes your income just over the OAS recovery tax threshold, costing you thousands in benefits you thought were guaranteed. The immediate action here is clear. Research the current OAS and GIS income thresholds carefully. Consider strategically drawing down a portion of your RRSPs in lower income years, perhaps before you even reach 65. Or specifically tailor your withdrawal plan in retirement to stay below those crucial clawback limits. This strategic planning can protect your valuable government benefits, ensuring a far more stable and predictable retirement income stream. But the issues don't stop there, because a pervasive myth about RRSPs continues to lead many Canadians astray. The #1 RRSP myth: it's not always your best option. For decades, the prevailing wisdom in Canada has been that an RRSP is always good. This blanket statement, I'm here to tell you, is fundamentally false. And it's a myth that's costing many Canadians significant wealth. For individuals whose retirement income might actually be higher than their working income, think about a Canadian who expects a substantial company pension, or who plans to work part-time in retirement. Or even for those who spend the bulk of their careers in lower income brackets, a tax-free savings account, or TFSA, can often be a profoundly superior choice. This widespread myth ignores individual circumstances, ignores career trajectory, and, most importantly, ignores realistic future tax projections. Consider a young professional starting their career in Canada, earning, say, $40,000 annually. Their current marginal tax rate is relatively low. If they contribute to an RRSP, they get a small deduction now. But if, by retirement, they're earning much more, or if tax rates generally increase, their marginal tax rate in retirement could be significantly higher. In contrast, every dollar growing and withdrawn from a TSA is completely tax-free, regardless of future income or tax rates. A detailed comparison of a TSA's truly tax-free withdrawals versus an RRSP's taxable withdrawals clearly illustrates this. Your immediate action step: critically evaluate your current marginal tax rate versus your projected marginal tax rate in retirement. If your retirement rate is expected to be higher or even just comparable, a TFSA might be the better vehicle for your long-term wealth accumulation. This brings us to the ultimate showdown. RRSP versus TFSA, the real winner financial advisors don't emphasize enough.
While both the RRSP and the TFSA are incredibly powerful tools for Canadians, the TFSA often emerges as the real winner for its unparalleled flexibility and truly tax-free withdrawals. This makes it an ideal vehicle not just for long-term retirement goals, but also for shorter-term savings and even as a crucial component of your emergency fund. There's a subtle reason why some financial advisors might push RRSPs more. Sometimes it's due to commission structures tied to certain products, or simply outdated generalized advice that doesn't consider individual nuances. The actual winner between the two depends entirely on your specific income profile, your future tax expectations, and your unique financial goals. Let's look at it simply. An RRSP gives you a tax break when you contribute, but you pay tax on every single dollar you withdraw in retirement. A TFSA provides no upfront tax break, but every single dollar you contribute, grows, and withdraws is completely tax-free forever. This also means TFSA withdrawals don't impact income-tested government benefits like OAS or GIS. For a Canadian expecting to be in a higher tax bracket in retirement than during their working life, or for someone who values complete withdrawal flexibility without impacting other benefits, the TFSA is often the superior choice. Your immediate action: maximize your TFSA contributions before your RRSP, especially if you anticipate a higher income in retirement, foresee a need for withdrawal flexibility, or want to protect your government benefits. But optimizing your retirement isn't just about choosing the right account. It's about how you manage it when the time comes. Mastering RRSP withdrawals: the secret to paying less tax in retirement, advanced strategies. It's not just about diligently contributing to your RRSP. The true genius of tax-efficient retirement lies in how you strategically withdraw those funds. This is where many Canadians leave significant money on the table. There are advanced strategies that can dramatically reduce your lifetime tax burden. Consider income splitting with a spouse. If one spouse has significantly more RRIF income, strategically gifting or using spousal RRSPs to shift future taxable income to the lower earning spouse can keep both individuals in lower tax brackets. Then there's the strategy of phased withdrawals. Instead of waiting until the mandatory RRIF conversion at age 71 and taking large sums, consider drawing down smaller amounts from your RRSP or RIF in your earlier retirement years, especially before other significant pensions like CPP or OAS begin. This can smooth out your taxable income over a longer period, keeping you consistently in lower tax brackets.
You could even consider controlled, early RRSP withdrawals during mini-retirement periods, sabbaticals, or years with unusually low income before your traditional retirement age. Your immediate action: develop a comprehensive retirement withdrawal strategy before you even think about retirement. Seriously consider consulting a fee-only financial planner for advanced, personalized strategies tailored to your unique Canadian situation. They can help you navigate these complex rules. But even the smartest withdrawal strategy can be undermined by two silent wealth destroyers that many Canadians completely overlook: the untold truth about RRSP fees and the single biggest mistake investors make. This is where your diligently saved money often silently disappears. High investment management fees, often disguised within the management expense ratios or MERs of mutual funds, coupled with trading costs, can silently erode your RRSP's growth over decades. These seemingly small percentages, often just 1% or 2% annually, can translate to tens of thousands, even hundreds of thousands of dollars lost over a 20 or 30-year investment horizon. It's like a slow, invisible leak in your financial bucket. And the single biggest mistake Canadian RRSP investors make? It's often a set-it-and-forget-it mentality. They contribute, they invest in whatever their bank offers, and then they fail to regularly review those fees or truly understand the underlying investments.
This leads to poor asset allocation, missed opportunities for growth, and clinging to high-cost products when far more efficient options exist. For example, a 1.5% MER on a mutual fund versus a 0.2% MER on a low-cost exchange-traded fund or ETF might seem insignificant year to year. But over 25 years on a $500,000 portfolio, that difference alone could cost you over $100,000 in lost compounding. Your immediate action: critically review your RRSP statements for all fees charged. Consider moving your investments to a discount brokerage and shifting your holdings into low-cost index funds or ETFs. Most importantly, regularly review your asset allocation to ensure it aligns with your risk tolerance and goals. By avoiding these costly errors, you keep more of your money, allowing it to compound far more effectively and securing a truly robust retirement. The truth about RRSPs might be uncomfortable, challenging deeply held beliefs, but awareness is always the very first step toward true financial empowerment. Every year you delay understanding these crucial nuances is another year your money could be working harder, smarter, and far more tax efficiently for you. Remember, true financial freedom isn't just about how much you manage to save. It's profoundly about how strategically you manage and protect those hard-earned savings from unseen threats, from silent erosion. Take control of your retirement narrative. Your future financial well-being literally depends on it. If this deep dive into the untold RRSP truths has opened your eyes, if it's shifted your perspective on Canadian retirement planning, please hit that like button right now. It truly helps this vital information reach more Canadians who desperately need it. Subscribe to the channel for more unbiased financial insights that cut through the noise. And tell me in the comments below, which RRSP truth was the most shocking to you? And what specific action will you take first based on what you've learned today? Your insights empower this community. The journey to a truly secure and prosperous retirement begins with understanding the full picture, not just the parts financial institutions want you to see, not just the generalized advice. You now possess the knowledge to question, to strategize, and to proactively protect your future. Don't just save for retirement, master it. Apply these insights, stay vigilant, and remember, your future self will undoubtedly thank you for taking these crucial steps today. This information is for educational purposes only, and not financial advice. Consult a qualified financial professional for personalized guidance regarding your specific financial situation in Canada. All investment carries risk, and past performance is not indicative of future results.